Hello guys, it's Max here from Daily Market Movements, and in front of me we have the S&P 500 futures chart. As you can see in today's trading session, we have fallen lower, currently trading at 3,854. I look at the S&P 500 and I can say that it's making more sense from a technical perspective than the Nasdaq 100. The Nasdaq 100 is just all over the place. It's up and down like a yo-yo, and so is the S&P 500. But at least we're still trading above the 50-day EMA. The Nasdaq 100 has had 3 or 4 negative breakouts. False breakouts, that is, towards the downside on the 50-day EMA. Then equally, it's had another 3 or 4 positive closes above the 50-day EMA, which have turned out to be false breakouts because they've actually declined the next day. So, and that is below the 50-day EMA, that is. So, very volatile in the US indices overall. I think the Dow's held up pretty well because it's more of the opening trade, and the S&P 500 is split between obviously tech and the opening trade. So, it's kind of, in the middle here. I probably prefer buying the S&P 500 at this moment in time, especially if you're a day trader over the Nasdaq, due to it being slightly less volatile. But the longer term, I do prefer Nasdaq. I think there'll be a fantastic dip to buy. But the S&P 500, where do I see it going? Well, we're trading down for a second day here. We've got the non-farm payrolls coming out on Friday. I really am anticipating some choppy trading, guys. I'm going to be honest with you. If that Friday's number comes in a lot higher than expected, then we could see further declines here. We could go and retest at 3,800, and we could even get a brief break below, maybe go down to 3,700. I think 3,700 there is some sort of support, as we saw here back in February. But the market's very, very, very sensitive at this moment in time. We have the 10-year yields rising yet again, so you've got to be very, very careful. Especially if you're new to trading, please trade with small amounts. Do not be risking large portions of your trading accounts. And when I say small amounts, I mean 0.5 to 1% of your overall account balance. It's just not worth it. If you want to take higher risk, then just take a break for a week or two and come back. I think that the S&P 500. The S&P 500, just as well as the other indices, so that's the Dow and the Nasdaq. I think they just need a week or two now just to kind of find where their ground is. And then once they've found their ground, that's when you can then start to place some more medium to long-term trades. I am still bullish. Do not get me wrong. We're still trading above the 50-day EMA. We're just underneath all-time highs. We're above the 50-day EMA. We're above the 200-day EMA. The RSI is in the middle. So the technicals are still looking great for the S&P 500. Do not get me wrong. Fundamentals are still looking great. We had Jerome Powell come out last week and confirm that the Fed aren't even thinking about hiking interest rates. The only fundamental that is currently worrying is, of course, the bond yields rising as fast as they have been over the past week or so. So once that fixes, what could happen is that the Fed may come out and take action on the bond yield prices rising, and that could give the stock market a vaccination, or a little injection of steroids, and it could rebound nicely. But I am still bullish here in the S&P 500 and indices overall.